Let's talk automation, the big tech trade, and the state of the economy with the one and only Downtown Josh Brown. That's coming up right after this. Welcome to Big Technology Podcast, a show for cool-headed, nuanced conversation of the tech world and beyond. We're joined today by Josh Brown, the CEO of Ritholtz Wealth Management, the host of one of my favorite shows, The Compound and Friends. He's also a CNBC contributor and the author of a great new book, You Weren't Supposed to See That: Secrets Every Investor Should Know. Josh, great to see you. Welcome to the show.
So great to be back. Thank you, Alex.
Thank you for being here. I think this is your third time on the show, so we always appreciate having you on. This time, we're going to talk about your book to begin with, and then in the second half, we're really going to go through all the big tech companies, including your perspective on companies like Nvidia, Amazon, and Apple. So folks should stay tuned through the entire show to get Josh's thoughts on what's going on with the big tech trade and these big tech companies in particular. But let's start with the book. There were so many perspectives in there about the market that I read and was like, okay, now it makes sense taking a step back. And we're going to talk about COVID in a second, but let's just start with the big tech trade, which you really say is something that stems from automation or fear of being automated, which I thought was a very interesting perspective on it. So I'm just going to read from, this is from a blog post that you include within the book. And sorry, I'm going to read your book out loud, and maybe you should do it. I don't know, but I'll try it this way and we'll see how it goes. Do you say we're in an age where we're being told AI is about to start writing its own software? Machines are going to be trying legal cases and diagnosing illnesses, writing songs and architecting buildings, giving financial advice and driving our vehicles. Every day more articles about this or that breakthrough. There are no limits. There are no protections. It's bordering on lawlessness. People have never felt more ill at ease about their own reason for existing, and this is manifesting itself in trillions of dollars being thrown at, of course, the companies that are doing all this automation and behind all this AI: Facebook, Google, Uber, Nvidia, Apple, Amazon, Alibaba, the list goes on. So let me ask you this to begin with. Do you think that this is really fear of automation, or just that this is where the economic growth is going in the economy? Because we haven't yet seen a decline in, let's say, employment because of automation.
Yeah, I think that any time that we're going through a wave of disruptive technology, this sort of thing is prevalent. But I think AI is different than all previous waves of technology, because I think everybody immediately grasps how much of their time is spent doing things that, if any other means of getting those things done were possible, the employer would default to those other means. So this is like not new, but obviously there were people that were by hand running calculations, and then the calculator came along. So I'm not breaking any new ground here, but I think in the case of AI, its ability to effectively ape humanity is what sets it apart from prior waves of technology. So I think that kind of like uncertainty about, all right, well, what's going to be my place in this world if this new technology is so good at doing what I do and doing it faster? This is not about being replaced by a computer. At this point, everyone's very comfortable in the world of computers. This is about having someone's essence at work be distilled down into an equation, and the equation doesn't need healthcare. So like that's why I think there's that sense of foreboding. And I think like a certain portion of the population is smart enough to understand new jobs will be created as a result of this. We don't know what they will be. Or your job at your company is going to morph into a different version of that, and you're going to be empowered to get a lot more. So there is a portion of the population that understands that. But then there's a portion of the population where it's just like, well, what does this mean for my future, my ability to earn a living? Maybe I don't want to change the way I do my job, or maybe I don't want to switch industries, or maybe I'm not comfortable having more and more of my work require me to have a co-pilot riding alongside of me. And for those people, I do think there's some element of like allocating to technology, because it's like, well, if this is going to replace me, can't beat them, might as well join them. And so that was what that post was about. Interestingly, I wrote it in 2017, way before ChatGPT or AI were on everyone's lips. So in the book, I wanted to bring that up to the present. And, one of the things that's held up really well is that we might be in the first fear-based investment bubble ever. Normally, when you have an investment bubble, it's greed. In this case, there's an element of, I better invest in this. And so that's what I thought was really different about this time around.
I'm going to push back on your idea here, but first I want you to tell one of my favorite stories in the book, which is that you had a friend who's a grocer.
Yeah.
And what
friend
happened
of a
when
friend.
they see
Yes.
friend of a friend, and what happened to them when they started to see big tech encroaching on their territory?
So somebody relayed this story to me. I think that it's a guy that owned a bunch of grocery stores in suburban New Jersey, and when he saw Amazon getting into delivering food, it was like, oh, okay. Maybe instead of putting all this capex into my supermarkets, I'd be better off just buying Amazon stock. And again, this might be 2014 or 2015, and I think he's okay now. I think
I did fine.
I haven't checked in with the person who told me the story, but I would imagine if he were allocating to Amazon rather than spending money on his own capex to improve his supermarket, he's probably gotten a much higher rate of return on his investment. And I told that story as sort of a metaphor for the way a lot of people were thinking in those days.
Right. Fear-based investment cycle, which is, again, talking about how you've been able to sort of take some of these broader themes and put them into terms I wasn't fully thinking about. Like, that's one of them. But now comes the pushback, right? Which is that, yes, you could say that, and maybe this is individual investors have that fear and they are pushing this way in the stock market. But when you think about what's actually happening in the economy, the story that I think the tech giants would tell, and I don't think it's an entirely illegitimate story, is that they are building the platforms that are enabling broader economic growth for everyone, whether that's supplying copilots or AI or even cloud computing, right? Because of what they're building, we have an economy that is growing, and the economy is growing quite nicely. People were talking about the fact that we were going to be in recession now. We're not in recession. And so, yes, a lot of the growth is going to accrue to the companies building these platforms that sort of are the catalyst for the growth economy, but we still have a growth economy. And so maybe it's
not pushback. We agree.
Yeah.
Totally agree with you.
Okay.
I don't think that what I was trying to convey is that this is the end and AI is going to put everyone out of a job. I was trying to convey the sense of foreboding that people seem to have been feeling at the earlier stages of this rally in 16, 17, 18. This is really the dawn of this Magnificent Seven idea. Back then they were calling them the FANG stocks, but it's the same kind of thing. Tesla wasn't yet a part of it, and it wasn't really about AI. It was just more about, you own a business, whatever you do, let's say it's a pharmacy or, let's say it's like a shipping and logistics company or whatever it is, and then you've got this company that's got $1 trillion market cap for the first time ever, and just endless cash flows, hundreds of billions of dollars in cash, tens of billions in cash flow every quarter. And anything that you're doing, if they want to, at the snap of a finger, they can just build it better, faster, and make it so that you no longer have a livelihood. That has not happened to everyone in the economy, but it certainly has happened to people in the economy, and nobody knows when it's their time. And if you look at what Amazon is doing with pharmacy, for example, you understand that the neighborhood pharmacists' livelihood is now probably on the clock. And it's not just the neighborhood pharmacist. All you have to do is look at a chart of CVS, which is in a 60% drawdown from its high, or look at Walgreens Boots Alliance, which is in a 90% drawdown. These companies are going away. As we speak, Walgreens stock is crashing on the market today. They said that 1 in 4 stores are unprofitable. That's unbelievable. In 2015, that was a $90 stock. And today, 9 years later, it's a $9 stock. And it's not coincidental that we now have a situation where opportunistic companies like Hims and Hers, as an example, or Roe, are utilizing the cloud, and they're utilizing technology to reach a huge audience of people that are just as happy to get their drugs delivered to them as they were to walk into a CVS and maybe accidentally buy a candy bar on the way out. Like that when you look at that as a business owner and you recognize how powerful both Walgreens and CVS were across America not that long ago, 100%, you're nervous. And so it's not that the economy is in trouble. It's that people feel as though their personal livelihoods are potentially in trouble, and it's hard to know where the next disruption is coming from and who's going to be affected. And it's happened before. It's not first time in history, but it's a legitimate concern that people have.
Right, and hence they invest in big tech because that's the sure thing.
Well, I mean, you say to yourself, well, I might be out of work, but at least I'm going to make some money investing in this disruption, and it's not crazy.
So on the Walgreens front, I kind of blame Walgreens for this, not the internet. I mean,
say more.
Open yourself up to a disruption when your experience is bad. And, you think about like a Duane Reade store, which intentionally designs itself as confusing. So you do find those candy bars before you get what you need. Yeah. And no wonder people would rather shop on the internet. So a lot of these old school industries, I mean, obviously it's troubling what's happening to them, but it's like there's always two sides of this, which is A, yes, the internet is causing trouble for you, but also B, if you were better at what you did, people would stick with you.
I'm curious what you think. Had CVS spent like huge amounts of money to buy Aetna and to buy Caremark. So buy an insurance company, buy a pharmacy benefits manager, and basically take a vertical approach to what was obviously going to be a consolidating industry. Those deals did not work out well. The synergies never showed up, et cetera, regulatory headaches. Had they instead said, instead of taking $70 billion and doing this M&A, we're going to cannibalize ourselves. We're going to close half our stores. We're going to cut our dividend. We are going to suspend our earnings guidance for the next 36 months. And instead, we are going to build the definitive way that people are going to get their drugs. We're going to have drones, and we're going to have our own shipping and logistics, and we are going to revolutionize this industry. I don't think the stock makes a new all-time high on that news. Now, in hindsight, we say, oh, well, they should have invested, and they should have. It's really, really hard to cannibalize yourself in the face of a competitive threat. It's obviously, in hindsight, sometimes the right thing to do. Really hard in the moment to make the decision that that's what you're going to do, especially when you have a shareholder base in the public markets that's counting on, reliability and dividends, et cetera. So that's from my perspective. I don't even know what they could have done differently.
I have an idea. So this is one of my favorite Jeff Bezos clips, maybe my favorite Jeff Bezos clips, and I'll try to recite it decently from memory. But basically, he's sitting down with the financial reporter who's trying to pin him down on whether they're an internet business or whether they're a brick and mortar business, because they have a website, but they were building all these warehouses, and the warehouses kept showing up on the balance sheet. And this reporter keeps pressing Bezos on it. He goes, internet or physical company? And Bezos looks at him and literally says, internet, schminternet. We don't care what bucket you put us in. We're going to be the best company serving customers, and it doesn't matter what category we're in. That will be our competitive advantage. So I think with the CVS, honestly, or Walgreens, whatever it might be, if they would have taken the money they invested in Aetna or whatever they were doing with their business plan and said, all right, we are going to pay our cashiers double. We're going to, maybe spend some money to design our stores better. We're going to have competitive hiring process because now these people are being well paid, so we're going to attract better candidates. And we're going to make people feel good when they're in our stores, as opposed to wanting to get out of them as fast as they possibly could. Like, it's no coincidence that Amazon built a store that the technological innovation is you don't talk to a person. You scan in, you take what you want, and you walk out, and it sends you a bill. Like, they saw that pain, and that's how Amazon gets ahead. It's like the simple old school business stuff.
The guy that developed the touchless technology for Amazon's retail was just pushed out of the company, and they are closing a lot of those Amazon Go stores because there just didn't seem to be anything magical that made people want to go to them. So I agree, but I do agree with you. The stores are a horrible experience.
Right.
And I just make the point that it's not obvious in the moment that the right thing to do is to trash your earnings projections and do this radical overhaul and reinvestment when you are running a company with tens of thousands of employees and you're not, these are not tech savvy people by nature. It's not like these chains are being run by former Microsoft engineers. So it's a tough thing. And if it's tough for Fortune 500 companies, imagine how a regular business person must feel when they're being told, like, oh, you have to compete. Not only do you have to compete with the local store across town, you have to compete with like Seattle's best. That's really unsettling.
But this is my point here, which is that I think that these companies cannot compete with tech companies by being more tech, and maybe that limits their growth over time. The only way to possibly compete with big tech and to compete with AI is to be more human, right? It's to make people feel good. Like that's something that technology has a really tough time with.
Well, you're right about that. But that's what they told the independent booksellers 20 years ago. That's it. They said lean into like how much your customer loves the experience. The problem is twofold. The customer might love bookstores, but only occasionally when they actually want something conveniently. That's never going to be the best option. And also, Americans don't read books anymore, which we can talk about if you want to.
Yeah, but we definitely.
So
we
it was
do
not
drugs.
It didn't work.
Exactly. I mean, I think some verticals might have been declining, but it's just really tough to compete with these companies based on technology. And it's definitely interesting that Amazon is pulling back on this Go experiment, although maybe there'll be some licensing down the road. But I think they definitely seized on the pain that the consumer was feeling most, which is that, I mean, I'm sure you've had it. You're like you have to go to a meeting, you need one thing. You're like, all right, I'm going to quickly pop into this Walgreens. Next thing you know, you're like 15 minutes late because that line just moved so slow.
I'll see you Walgreens and I'll raise you the self-checkout lane at the supermarket.
Oh man,
which is the ninth circle of hell. Nobody knows how to do it. We've had these things now for 15 years. Nobody. It's like watching people land on an alien planet and try to figure out how to start a fire.
No doubt.
And they now need two people at my supermarket to help everybody at those self-checkout lanes. Those two people could have just been cashiers, and we could have called it even. So,
yeah. I know, it's true. I mean, that's where I get most of my podcast listening done. Just on 2x speed, waiting to check out, Stop and Shop. So let me ask you one last part about this, which is that, okay, let's say we do go from this like era where people end up having their work automated or taken over by these conglomerates or technology. How does that shift the nature of our economy? Is it increasing inequality, or what exactly does it do to...
I don't know. So you know more about this than I do, but like, let's say hypothetically you have a job, you're coding at Microsoft, and then they put this thing on your computer that helps you. And all of a sudden, you're able to code twice as much over the course of 20 business days in a month as you were 3 months prior, because you become really adept at utilizing these AI tools, and you become better at your job. The company becomes more efficient, and everyone's happy. But then, like, what happens after that? Because now there's a new baseline on how much work you're expected to complete. Like, it's not like you can't go backwards. You can't say, all right, I'm going to revert back to, okay, so now everyone's doing more, getting paid the same, doing more, and then all of a sudden, that ride along AI that's watching you work and helping you and offering suggestions, all of a sudden it starts dictating to you because they improve that software, or the software improves itself because it's generative and it's seen enough and it knows where Alex continues to make mistakes. And before you even get a chance to make that mistake, it's already in front of you, either telling you what to do right or doing it for you before you can mess it up. And it reminds me a lot of the road toward full self-driving or self-driving or autonomous vehicles. Every time I lease a car, it's a little bit judgier. It's got a little bit more opinions about how I shift lanes, and we're used to it. And we're getting these haptic little taps and buzzes on our elbows, on our asses, and the steering wheel shakes a little. And we're probably becoming better drivers, but also we're getting very accustomed to having somebody be in charge of us. And it's not going to be long before the car is just better than us. Of course it will be. Why wouldn't it be? And so I don't know how long that takes. Do the haptics get like stronger? But you know what I mean? Or do those noises where you're not braking fast enough and it tells you, no, really brake, really brake. So again, I'm not painting this as a negative thing. We could all probably be more productive if we're sitting in a car rather than holding the steering wheel for an hour. I totally agree with that. My point is the expectations on the part of our employers are just going to go up as we become more tech-enabled. So we're doing more, not necessarily being paid more, and many of us are going to reach the point where the quote-unquote co-pilot actually should just be the pilot. And again, maybe that's great. Maybe that frees us up. We could all be painters. We could all go to Tahiti and paint. But like, I understand the part in people's minds where this is not necessarily going to be great for them personally.
Oh, without a doubt. I mean, I wouldn't minimize that for a minute. I mean, my thought is that if we do end up having effective co-pilots, it won't necessarily be you're doing twice the work, is that you're actually doing the work you want to do. And I mean, that's
a great outcome.
As opposed to like having to clean up code and like, build like it's the same thing like right now with open source, right? A lot of the code is available, but you can just build on that instead of having to build from scratch, and you're actually able to do things. Like there's no software company who says we have a limited roadmap. Once we build that, we're good. Like every software company wants more capacity to do more things. And so therefore, like if the AI can help code, you can just end up building more in the best case scenario. Are some people going to be on the street because of it? Yes. Are they probably going to be on the street because they're working at the worst companies and not the best ones? Also, yes. In my perspective.
Yeah, and it will happen with or without AI eventually. So I definitely see that, and that's a best case scenario. What you're outlining, it's like all these people can take the 20 or 30 or 50% of their job that's just rote, kind of like just like going through the motions because somebody has to do it, and they could throw that out and let that get done via technology. And they can do the other half of their job that they really are appreciated for and the part that makes them creative and unique. The thing is, not everybody is a creative. Not everybody wants to do something other than rote tasks. There are a lot of people who find comfort in that type of work, and that's what they want to do. And they're not suited for a world where they get half their time back and they're supposed to come up with creative ways to impress their boss. That's just it's not going to be a win for everyone.
I agree. I mean, I think that there's another great Jeff Bezos scene where he's with Walt Mossberg at the Recode conference, and he's talking about what it takes. Because Amazon's been doing this since the mid 2010s, and I wrote about this in my book about how they've sort of gone automation before everybody else. It's always been a priority for Bezos, and he's sitting with Mossberg and talking about how you're going to work at you're working at a tech company. You have to be prepared for that type of change. And he goes, if you don't, you can find a different job that doesn't value it as much. He's like, go work in insurance. And then he like pauses and he goes, well, insurance now is already becoming tech enabled. And Mossberg is like, well, you have an iPad, but even more. I think Bezos was thinking one or two steps down the line, which is that you have you will have machine learning that will be assessing damage, that will be doing predictions, and here we're here already. Like, what does an actuary do? Right? Does that get taken over by technology? So for me, yeah, I think that like I'm not celebrating this change. It will be hard in some ways, but I ultimately do think that we live in the more optimistic scenario, and I also think that less people are interested in the rote work than we might imagine. I think if you think about it, people some people might just not want to work. But I do think if you show up for a job, some people are going to be interested in doing something meaningful. And like copying data one Excel sheet to another is not the thing that makes them happy.
Yeah, so I'm equally hopeful that we're going to unlock time for people. And it seems that the amount of work that you have to do will always expand to fill the amount of time that you have. That's just like,
yes.
People don't sit, in America, people do not sit around.
No.
So I agree. But one other component of this, which we
let me
didn't
just
really
say,
oh, please.
That you could be one of the big tech engineers that they have two jobs, right? They in the work from home era, they were working for like Google and Facebook at the same time. So
right, we don't sit around.
Will be able to figure it out. Oh, sorry, sorry.
So
go ahead for the second.
So
point.
A little bit closer to home, there are now 10 different companies, and then on top of which these are startups, but then on top of which you're getting offerings from Zoom and Salesforce and big existing enterprise software companies. But there are 10 different companies specifically building AI note-taking for financial advisors. So I have 27 client-facing financial planners at my firm. The most valuable use of their time is talking to clients, like without a doubt. If the more face time that they're giving our clients, the better. And anything that they're doing that takes them away from that is not time well spent for the most part. But the thing is, in order to prepare for a meeting with a $10 million family that you're managing money for and handling their taxes and their insurance, it's like maybe 45 minutes to an hour worth of prep before you go into that meeting. You have to go back and look over everything that's already been done, what's still to be done, what accounts have we opened, what are the returns, So you have to prepare. You can't just walk into that meeting like, oh, hey, how's your golf game this summer? All right, so there's that. Then you do the meeting. It's an hour. It could be 2 hours. Depends on what's going on. Then you come out of the meeting, and there's probably 30 minutes to an hour of post-meeting kind of debriefing of the rest of the staff. We need to open this type of account. We're doing a wire. We're funding this charity right now. We need to call this person's attorney about some estate paperwork. The AI chatbot that's going to be a note taker during the meeting is now capable of prepping my advisor within 5 minutes, all of the highlights of the last 3 calls. Here's what you need to know. Then you do the meeting, and then you come out of the meeting, and that same piece of technology is able to send an email to everyone who was on the meeting. Here's a summary. Here's what was said. Here's who said it. Here are the action items. And not only can it summarize the action items in an email, it can actually send instructions through the CRM to the financial advisor's admin, who will then have to take action based on those. This is tremendous. This is an incredible thing that's going to make it so that my advisors probably have an extra 2 hours a day talking to clients rather than, dictating action items. I love this. But then I had a second thought, which is right now we have a junior advisor riding along on some of these calls. That junior advisor is getting reps in these meetings, listening to the discussion and taking notes and following up and executing all these tasks after. When I don't need that person, who's probably a 24-year-old getting, $85,000 in their first year, when I don't need that person and none of the other firms need that person, and that goes on for 5 years, you've kind of hollowed out the way that you've historically trained young advisors and made their salaries worthwhile to the firm. Now what? Where do those people enter our industry from? Who makes use of them? How do you get money back for the cost of supporting them for the first couple of years? Because as you know, Alex, there's no wealthy family that's going to be happily assigned a 24-year-old advisor, right, absent somebody that's a little bit more senior. So look, it's an existential question for just like, how do we train entry-level people in this country if we're creating endless amounts of software that can do entry-level jobs better than a kid right out of college can do? And I'm sure we'll solve it. I'm sure we'll come up with something, or we'll turn into Japan for the next 30 years, where young people have absolutely no hope for the future and don't think that they will be able to be as prosperous as their parents or their grandparents. I don't have the answer, but I know it's the big question.
Okay, I have two follow-up points on that. First, the point that you made about the software that will take the notes for financial advisors, that exists in every single discipline. Not necessarily the software, but the same problem and the technological opportunity. Just think medicine, for example. My father just retired. He was a podiatrist. He spent half his life doing paperwork, right? Yeah. And this is going to be a thing of the past. Like him having to sit in the basement filling out these electronic medical records. No doctor is going to have to do that again because this is all going to be generative AI. The doctors will simply check the output, and the list goes on in every single profession.
Absolutely.
So I think that this is the benefit from this versus like maybe there's like that small percentage of people who enjoy taking the, doing the note review or enjoy doing the paperwork. This is going to be a huge benefit. And I can't believe I'm being this optimistic about it, but now thinking it through, I think it'll be a huge benefit. Now for the junior entry level work, I think it's a real issue. But here's like two thoughts on that. First, for a firm like yours, it's probably going to be important to have a strong bench of young talent. So even though it might not pay off like right away, there might be some incentive for you to have them in the firm.
What do I do with them if the AI note taker that Salesforce provides me or Zoom provides me or Microsoft provides me is more useful and costs nothing? Like, what do I do? What do I do with that junior person if I don't need them in the meeting? And how are they going to learn to be an advisor if they're not needed in the meeting?
Yeah, so there might be just more extended training. But I think the second point that I wanted to make here, and by the way, like maybe that's too sunny. It probably is too sunny now that I'm saying it out loud. But the second point here is that, we do have declining birth rate in the U.S. and in the developing world, developed world in general, right? And so you're just going to have much fewer sort of people seeking jobs in those entry level fields than we have now. And you might need the AI. The reason why Japan has pushed so hard into AI automation, I think you even talk about this in your book, the factories that are just like lights out factories where you don't have anybody, is because they needed it. Yeah. Like in Japan, they didn't have enough of those young people seeking jobs. And in the US and in China in particular, that's going to be a major issue as we look 10, 20 years in the future.
I guess the question is the next 5. I guess for me, the next 5 years.
Yeah, I mean, they always talk about how, like, in a technological shift, there's going to be pain, and that's probably what's going to happen.
Well, listen, I like to be optimistic too, and I guess just from my perspective, it's worth bringing out both sides of this. Yes, companies are going to become fabulously profitable as they institute all this amazing technology that's coming down the pike. And it's already happening. And of course, we're going to get rid of a lot of busy work that people should not be doing anymore if they don't need to. 100% I agree. But the second order effect is like, how do you be an entry-level employee in the age of AI? We're going to find out.
Yeah. No, I don't think you're off base at all in bringing that up. It's going to be a problem, without a doubt. And, you mentioned, okay, maybe if people have their work automated, they'll just have a good life and they'll paint or something like that. But that sort of brings us to the most interesting part of the book, at least from my perspective, where you write about what happened during COVID when we had all the stimulus and people were empowered. And effectively, basically, people were empowered to do whatever they wanted. And effectively, the economy broke because of it.
Yeah, paradoxically, it's not great when everybody has all the money they need. It's catastrophic for capitalism.
So I think I should just read this section of the book because it's so good, and I condensed a little bit. But you write, capitalism felt like it offered possibilities for everyone for the first time ever. This is in the COVID times. Everyone had money. Everyone had options. There was a bull market in people forming their own LLCs and starting companies, a bull market in sitting on their asses and doing nothing, a bull market in quitting jobs, a bull market in whatever they felt like doing, indulging their hobbies, accepting flexible hours, moving their residence, taking college classes while being employed, secretly having 2 full-time employers, quitting without quitting, being paid for waking up in the morning, taking extended periods of time in between gigs, making a big career change. Whatever people wanted to do, they could do. Freedom on a previously unimaginable scale. And that was the problem. Widespread prosperity, it turns out, is incompatible with the American dream. The one and only way our economy works is when there are winners and losers. That's what we learned at the conclusion of our experiment. You weren't supposed to see that. Now the genie is out of the bottle. For one brief shining moment, everyone had enough money to pay their bills and the financial freedom to choose their own way of life, and it broke the economy in half. So this idea that we could end up in utopia, which a lot of people, especially folks like in the sort of extreme areas of AI, like the thinking parts of AI talk about, basically your perspective is we had this already in COVID when we gave out stimulus. People were empowered in a way they never were before, and it broke the economy. It got out of hand. We had the NFT craze, inflation, and then effectively the government was like, let's restrain this and break it. And then you saw the rise in interest rates and the attempt to spark a recession.
You really got to read the full chapter of that book.
I agree.
If you're not you,
No,
if you're
I'm
listening
saying
to this,
listeners, yeah.
because what I lay out is the sheer amount of spending, not just spending, stimulus. So that's fiscal policy, monetary policy. It was so endless. It was like 20-something trillion dollars plus 0% interest rates, plus a raging stock market that allowed anybody who wanted to go public. I mean, it was just like this once-in-a-lifetime situation where we flooded people's bank accounts with cash. We flooded people's 401ks with gains. The value of suburban real estate went through the roof. Like just everything all at once made people feel, for the first time ever, everyone, that they could do whatever they wanted. And the result was 9% inflation in the United States. And that's just headline. If we get into individual components, forget about it. There are things that quadrupled in price that'll never go back again. The UK had 11% inflation. We cannot ever again run this experiment, because effectively what happened was the people who really hated their jobs were able to just not show up and do them. So you would check into a hotel and there was nobody to clean the rooms. So they would say to you, all right, the hotel's open, COVID's sort of over, but we don't clean your hotel room. You had restaurants begging people, doubling the salary and then doubling again, begging people. You had trucking companies that couldn't find drivers. The ports shut down. You literally couldn't move shipping containers because people are doing like a I fix bicycles startup in their backyard. And listen, it's not for me to say who doesn't deserve to get their happy ending. That's not right. All I'm saying is the reason capitalism works is you have people at the top of the heap that have already made it, probably because they killed themselves to get there. And then you have people who want to be where they are and are willing to do the jobs that are necessary in order to get there. So you have the super rich, and you have the lowest income households, but then you have this group in the middle class. The middle class has to strive. Otherwise, it falls apart. The middle class can't ghost quit. They have to show up to their job. And not only do they have to show up to their job, they have to buy lunch next door to their office. They have to do these things. And if enough people don't do these very normal things, everything breaks down. And that's what we went through. We had an 18-month period of just the most bizarre science experiment. And it turns out the American dream doesn't work if we all get it at the same time. So, and again, it's not for me to be the arbiter of who gets to quit their job and start the company of their dreams and who has to show up for work. I'm not saying that any one person should determine that. I'm just describing a situation where you can't have everybody be in a place where they feel fine about either working or not.
Right. And it is crazy that the Federal Reserve was basically like, we need to try to force a recession to get people back to work.
They never said it, but that was the explicit policy aim.
Right.
We need to crash this economy to get people back to their jobs. It's crazy. Right. I mean, it didn't work. They weren't able to do it, thank God. We got inflation down anyway, despite their efforts. But they, listen. If what's so wild is that you basically had people become professional baseball card traders. You had people leave New Jersey and move to Montana. Like, not like two people, like millions of people did something completely different for 18 months. Some people became amateur bakers. Some people, myself, became very casual alcoholics. Like, everybody got to like live their version of I do whatever I want now. And one of the craziest things, Alex, even like a year ago, there's an element of this that's still with us. Like, I remember I had to go to the mall to do a return. I was helping my wife with something on like a Wednesday at 10 o'clock in the morning. And I look around and the mall is full. What the hell are all these people doing? You know what
Shopping.
they're doing? They're walking around with AirPods taking customer service calls while they shop and do errands. Like that's literally what's going on. It's still going on. So we're probably permanently changed as a society as a result of the COVID period. I don't see how we get everybody to forget about it.
Let me ask you this, Josh. Do you think this could have worked if we didn't have the inflation?
But the inflation is caused by it.
But okay, let's say that, I mean, maybe this is an impossible hypothetical, and if it is, call me out on it. But let's say that most of the inflation was caused by the fact that the supply chain was broken, and we know it was broken during COVID. That shipping a container went from China to the U.S. went from $2,000 to $20,000, and that was reflected in consumer prices. If we could find a way to do this sort of policy that allows people the flexibility to do what they want and keep inflation in a reasonable rate, do you think it makes sense? Because I'm also speaking as someone who's, one of those peoples that did that career shift, started the podcast, in August 2020, quit my job in May 2020. So like that flexibility actually ended up being quite good for me. And I think, probably added to some economic activity if we could have people find the true thing they should.
Yes, you could turn customer service into chatbots and people are satisfied with the outcome of those interactions to a reasonable degree. And then if you can turn every McDonald's and Starbucks into a combination kiosk vending machine, which Sweet Green is doing with salads right now in Manhattan, go to the One Penn Plaza outlet of Sweet Green. I own the stock, full disclosure. It's a vending machine. They have a machine in there that makes between 500 and 800 salads an hour during the work week. You order from a screen, and the machine makes you a salad. And the calibrations of ingredients and dressing, and it's perfect. It's a machine-made, flawless chopped salad. If you think about how many people do you need to make 500 salads during 12 to 2 p.m. on a Monday? I don't know. Is it 15 people, 20 people? So if those people don't need to be there anymore because the kiosk is taking credit cards, cash isn't changing hands, nobody has to monitor the salad assembly line because it's a computer with very powerful machinery attached. Like if that's where this is all headed, then absolutely. There's a universe in which we can survive 10 to 15% unemployment and still like have a fairly good economy. I just think the people that are not working but want to work are not going to be happy. Right. And look, in the book, I reference Vonnegut, and if you haven't read Player Piano, I highly recommend this book immediately after you read my book. Kurt wrote this 70 years ago, and it's still relevant because it's about humanity. And so in the future that Vonnegut envisioned back in the 50s, basically had white-collar managers who ran these massive industrial conglomerates, and you had basically people that used to do something for a living and are no longer needed. And the ultimate result is an uprising, even though those people were being cared for. They weren't discarded in the street. They had homes built for them. They were fed. But it's at a certain point, you feel just absolutely useless. You feel suicidal, and that's when the opioid shit starts. Like it's just not realistic to think that the version of American capitalism that you want is a version where a lot of people could just walk around talking to trees all day. It's not good for the soul. People need to feel needed. They need to actually be needed, and they need to have a purpose. And the purpose can't just be have as much fun as you can today. It's not good. It's not workable. You have to be eating mushrooms in San Francisco, in a dorm room conversation at 2 a.m. to think that this is where things should be going. It's really not.
Well, I can tell you a lot of the inspiration for that perspective on where things should be going does come from those,
which is fine.
Mushroom sessions.
And then wake up, sober up, and realize that people need to be wanted. And you know this, and I know this, and we have 4,000 clients. Okay, so we talk to people that have done every single thing for a living you can imagine, and we talk to people who inherited money. We talk to people who were poor until they were 50 and something finally happened for them. We talk to people that had early success in their 20s and then lost it all and had to get it back. We've heard it all, every version. There is no version of people who are happy and satisfied with their life that has anything to do with I wake up and do whatever I want. It's just that is not the story that we ever hear. The most satisfied people are maybe not the busiest people, but the people who genuinely feel that they are most counted on, even if it's just by relatives. And I just think that's endemic to humanity. It's always going to be that way. So it's a lot of fun to grow your own weed, bake your own bread, drink 7 nights a week, whatever people did during that period. But it literally could not have gone on longer. And if it did, it would not have led to anything good societally. And, could point to Jan 6, could point to the Black Lives Matter and the responses to that. When people had too much time, it was too much time for us to look around at each other and get into fights. It's not great. So I like full employment. I think it's better than, hey, guess what? The software does your job for you, and you have $5 million in Apple stocks. You don't have to worry about anything ever again. I don't think that the person you say that to is better off 2 years later.
We're here with Josh Brown. He's the author of You Weren't Supposed to See That, Secrets Every Investor Should Know. We've been talking a little bit about the book in the first half. Second half, we're going to talk about some of the big tech companies he's looking at in the market more broadly. We'll be back right after this. And we're back here on Big Technology Podcast with Josh Brown. He's the CEO of Ritholtz Wealth Management. He also hosts The Compound and Friends, one of my favorite shows, CNBC contributor, and the author of You Weren't Supposed to See That. Josh, let's talk a little bit about the market coming back here for the second half. So we also talk a little bit in the first half about how the Fed tried to force a recession. Well, I think this was supposed to be the year that was supposed to happen. The S&P 500 is up 23% year to date. We've been hearing about, recession, hard landing. Rates are going down now. Inflation is lowering. So mission accomplished? What do you think?
Well, I had on the Compound and Friends last week, we had Dr. David Kelly, who's probably the highest ranking strategist at JP Morgan. And
great show.
His perspective is that the Fed really had nothing to do with it. We had these temporary supply imbalances all over the economy, and we had all these labor market issues, again, stemming from how stimulated everyone was financially. And those things worked their way through the system, and reality came back, and it turned out that the economy kind of healed itself. That's like a stylized version of what he was saying. I'm not as smart as him, so I wouldn't disagree with him. I think the Fed does play a role, but there are a lot of people who think demand for capital is ultimately going to get to where it needs to get to. And, the Fed can exacerbate the direction one way or the other. But here we are, to your point, Alex. At the end of 2022, the idea that we would have a recession and a hard landing in 2023 was effectively consensus. This is the unanimous opinion, pretty much, of Wall Street strategists, of mainstream economists, of CFO survey that they do at Duke University. This was just what people said. It's happening. This is it. We're going to have the hangover from the pandemic era stimulus, and there's nothing you can do about it. And we didn't. And I think a big part of why we didn't was the consumer ended up being more resilient than we thought. And it turns out we don't really have an economy that's highly dependent on manufacturing the way that we used to. So it's not like, you have a street with 10 people living on it and 8 of them go to work at the plant all day. And when the plant lays people off, the economy goes to shit. It's just not the version of America we live in right now. So that was helpful. Services-driven economy is going to be less susceptible to higher interest rates. It's not part of the manufacturing cycle of booms and busts and inventories. And okay, so there's that. The second thing is we had this AI genie come out of the bottle, and that nobody could have predicted that. Maybe you could have. Powell couldn't have.
Certainly not, yeah.
So GPT hits on November 30th of 2022. Coincidentally, the stock market had bottomed 2 weeks prior. We're celebrating the 2-year anniversary of the stock market as we speak. I don't know if you know this. Most people don't. The NASDAQ is up 28% on the year. This year!
Yeah, it's crazy. It's
all right.
The growth this year has been out of control.
So that's all AI. So we have a raging stock market. We have housing activity renewed because mortgage rates are falling finally, and people feel less trapped in whatever their situation is. We have inflation moderating. The Fed has done its first interest rate cut, and they started off with a double cut, and they'll probably do another one in a couple weeks. And we have this election that everyone was terrified of, and it looks like actually the outcome is going to be still up in the air, but probably lead to a divided government, which is positive for stocks historically, where no one party gets to do a lot of weird shit in either direction. And we'll get through this election, which is a big bad thing that everyone's worried about, and that'll take place. And God forbid we have an inauguration where one side concedes. That'll be interesting. But so like a lot of the negative potential catalysts that we've been living in the shadow of are fading. Doesn't mean something bad can't happen out of nowhere. I'm just describing the things that we were terrified about.
Right.
And so that's really the story of what's happening right now. We've had earnings growth this year. We were already supposed to have been in a recession as of last year. So it seems as though it's a new bull market, and it's 2 years old.
And in your book, you describe something called this relentless bid. And, basically that's everybody's putting money into their 401ks. Traditional retirement is not what it used to be. That money, 401k money, is going into equities, and it's just effectively coming into the stock market month after month, quarter after quarter, and that is relentlessly bidding up the stock prices, and effectively has a put in terms of how low it could be. I'm sure I'm butchering this a little bit. But basically, yes, we are seeing earnings growth, but how much does that relentless bid have to do with the fact that we have gone through this turbulence and the stock market has grown the way that it has?
Yeah, so I don't want people to think that that's like my justification for buying stocks today, is that 401k money is going to just keep coming in and levitating the market. I wrote that in 2014 and originally. So it was my way of describing the process by which the actual behavior of the stock market had begun to change because of two things. One, this wave of price-insensitive money. By the way, 401k is $11 trillion, okay? People are adding to that $11 trillion every 2 weeks when they get paid. They do not consult the PE ratio of Apple. It's an automated decision. The money comes in no matter what's happening in the economy or with politics or the weather or sports. Like nothing enters people's thinking. It's just a wave of money, and it keeps coming in. The boomers, the wealthy boomers, they don't even have to take money out. They can just borrow against it. Like if a wealthy boomer wants to buy a vacation home these days, the guy at Morgan Stanley says, okay, no problem. We'll here, sign this paper. We'll give you a 50% borrow against your treasury bonds. We'll give you a 30% borrow against your stocks. It's a non-underwritten loan, so it takes 5 seconds. The only thing you have to do is not buy more securities with it. You take the money out of the brokerage account, go buy the house. Now you don't have to sell your stocks, and you have a second home. Boom, magic. This is the securities-based lending is like one of the driving factors of. People said there's a guy Harry Dent. He's a demography guy, and his big thing was in the year 2020, every baby boomer is going to turn 70, and they're all going to simultaneously liquidate their portfolios. No, it's actually not how it played out. Now they borrow against their portfolios. They don't even pay capital gains tax. So you have that. You have this 401k wall of money coming in. And then you have a new business model on Wall Street. When I wrote the piece 10 years ago, Morgan Stanley, Merrill Lynch, now Bank of America, JP Morgan, UBS, all the wealth management units at the big investment banks and brokerages were converting their stockbrokers into financial advisors and changing their comp model. They were trying to push them away from commission-based transactional brokerage business and push them more toward fee-based asset management business. And it worked. And one of the side effects of that is financial advisors like myself are building financial plans for their clients. And the plan doesn't say to sell stocks. In fact, when the market dips, the plan says, hey, actually, you should be buying more stocks and rebalancing because it's going to make the probabilities for your client go higher. So you've got this automatic bid coming from the wealth management side, these 70-30, 60-40, 50-50 portfolios where when stocks sell off, bonds get sold, stocks get bought. And the effect of these forces that I'm describing is a dampening of volatility, and it is a acceleration of the correction process. So it's not that we don't have corrections. We do all the time. They don't last long because the wealth manager with $50 billion under management pulls the lever and there's a firm-wide rebalance across all of their accounts. And the wall of money from 401ks comes in. And, oh, by the way, nobody's actually selling their securities for any reason. They certainly aren't selling it to live on in retirement. So this is like profound shit to me. I don't know how interested your audience is in this, but
no, we are for sure.
It's if I could anthropomorphize the market for a minute, I would just say it's like a new person. The old Mr. Market where everybody was like on tenterhooks. Every time something would go wrong, everybody would panic. Nobody panics anymore. They panic buy.
Yep.
They look at the response to Israel being invaded. Look at the response to the Ukraine being invaded. Look at the response now. Iran's I don't know, within minutes of obtaining their first nuclear bomb. People panic buy stocks when these things happen. It's crazy.
Yeah, it is crazy.
But it's happening.
When there was that mini crash on the beginning of August, you'll remember something went on in Asia, I think, where the market dropped like 10% in a day. It was the first day of my vacation. My summer, I talked about this on the show. My wife and I, we landed in Ireland where we were spending a week. And as soon as we did red eye. So we watched the Asian markets collapse overnight. And then this was in Japan. Something happened in Japan. Anyway, a second we get on the ground, I'm like, just go buy the S&P 500 and do it as soon as you can. And the market's up like very nicely since then.
Yeah, what you're describing is the yen carry trade. So basically, the United States cut interest rates, and Japan Japan raised interest rates. They are terrified of inflation for some reason. So as a result of that action, all of a sudden there's this thing called the yen carry trade, where people are borrowing money in Japanese yen terms, and they are using that money to buy things like stocks and real estate here in the United States. Warren Buffett is involved in the yen carry trade. He sold bonds denominated in yen and used that to fund the purchase of Japanese equities. So the Japanese carry trade is something that institutions and hedge funds are using as a way of obtaining cheap funding, which leverages their buying power and magnifies their returns. So when the Japanese raised rates and the United States cut rates, it was like a blip in the carry trade. It was a margin call. Some people had to sell some stuff, and then that had a ripple effect. Japan had a mini 1987. Some of their biggest publicly traded companies like MUFG were down 25% in a flash, which is obviously terrifying. And then here in the United States, we had this crazy, wild pre-market where people thought the stocks were going to like open up down 10% and keep going, because the muscle memory of that is still there. Like people remember these panics, these crashes. What ended up happening was it was the best buying opportunity of the year, to your point, and we didn't hear from a single panicked person.
Wow.
Not one.
Yeah.
Because there's no time. Because even if you wanted to panic, the market went green like later that day. Like God damn it!
Crazy.
Like what?
Yeah.
So you know this, and I think it's a great story that you told, Alex, because it's emblematic of just this time that we're in right now. There's a higher proclivity to panic buy than panic sell.
Yes. Okay, we have about 10 minutes left. Let's quickly do Amazon, Nvidia, and Apple, if you're up for it. So
I own all three, full disclosure.
Yes.
So
Amazon. I want to ask you this question about Amazon. So
Yeah.
I was on with you guys on the Compound and Friends in July, I believe, and we had a debate, you and I, about like whether Amazon was looking up or not. And you kind of sold me on your viewpoint, but I had mentioned that there was some weird things going on with Amazon culture. Lo and behold, September 16th, Andy Jassy comes out with the memo. We're going to do 5 days in the office from now on. And he also points out, as this is the most pointed admission of cultural problems in Amazon history from a CEO. He said, we have added more layers than we had ever before, and it's created artifacts that we like to change. That means pre-meetings for the pre-meetings for decision meetings, a longer line of managers feeling they need to review a topic before it moves forward, owners of initiatives feeling less like they should make recommendations because the decision will be made elsewhere. Truly day two type of culture taking place in Amazon. But obviously the company has existing assets that are quite strong. So what's your perspective on the Amazon trade right now?
Look, I think the expectations for Amazon are very low, and the stock is selling at a discount to the multiple it sold at in the before times in 2019. And they'd never, ever gotten their premium valuation back. And you can't say the same for the rest of the mega caps in tech. Meta looks outstanding right now. Nvidia looks outstanding. Amazon and Tesla are probably the furthest away from their 52-week highs of that group of stocks. I think Apple made a new high today. So Amazon is absolutely being treated as though there are issues there. Like, I don't think when they go into this next earnings report, people are expecting any sort of like upside surprise or anything like that. So it's kind of in a weird place, but from my perspective, that's why there's an opportunity. And we just went through this cycle with Meta. The stock was in a 75% drawdown. People forget it's since, I think, more than tripled. So when companies have problems and they address them and they admit to them, it's like the first step of like, hey, we have to change something here. So I don't know how long it takes for Jassy to get his act together, but I think the stock's going to work.
No, definitely. I mean, maybe this memo that Jassy sent is his year of efficiency memo, saying that the company needs to figure it out from a cultural standpoint.
Yeah, I mean, that's certainly how it could turn out. Look, there are some idiosyncrasies with Amazon in terms of like on the retail side, they've been gaining share with the essentials. The problem is with the essentials, it's not a very profitable business. It almost feels like they're playing defense by pushing that so much just to make sure someone else is not getting those sales. So people don't get excited about that. There's a lot of questions about whatever they're trying to do on the entertainment side. Like, it's not a clean story. It's not, right? So, but
Definitely.
Again, that's reflected in the fact that this is still selling at a discount to its historic multiple. And, the bears would say, well, it should. And I guess I would agree. The real question is, will it always?
Where it goes.
Yeah.
Okay, Apple, as you mentioned, hit a new high. It's closer to $4 trillion than it is to $3 trillion, which is to me just nuts. Because if you think about the context, Apple Intelligence has been pretty lukewarm, like a true meh release. The Vision Pro has gone nowhere, and they have issues in China, which is 20% of their market. So what do you think explains the sort of, speaking of a clean story and not, the sort of disparity there between Apple's story and its performance?
You failed to mention that the Vision Pro, probably the thing that people were most excited about for them to launch other than AI, has been a flop.
Yeah.
Like unmitigated. Like nobody is
Did I
saying
think
that
I
was
mentioned
successful.
that? Maybe if I forgot it, it was anyway. But go
So
ahead.
I guess this is the way I would put it, and this is a very realpolitik answer. In the end, it's cash flows and earnings, and do you have them or do you not have them? And Apple has them, and Apple basically it's a $200 billion cash hoard with which they can pursue $300 billion worth of buybacks off the cash flow alone over the next couple of years. So they can buy in a ton of stock, and they are churning out plenty of profits as a result of the services business staying strong. And they can have a flop here, a flop there, an underwhelming iPhone launch, etc. But they get the benefit of the doubt from the investor class that whatever's wrong or half baked in the case of the AI effort, like they will eventually figure it out and get it right. And like yesterday, they dropped a hint. I don't know who sourced the Wall Street Journal, but like Apple is considering a lighter weight headset. Yeah, no shit. Because Facebook is Meta is selling a ton of the Ray-Bans, and now they're going to sell this Orion unit. So obviously, like that's where the ball is. So Apple's considering it. You know, okay, I'm sure it's like all hands on deck internally. They must make sure that the next iteration of the Vision Pro is a little less dorky.
Think it's a problem for Apple that Meta is beating them to the future of AI and mixed reality?
Yeah, I watched Zuckerberg on stage with the Acquired guys talking about like denigrating the phone as the center, he basically said you're all suffering from this huge amount of recency bias just because the iPhone has been the dominant lens through which we view the internet. That doesn't mean it's going to be the case in the next 15 years. And he kept saying, listen, if you really want to look at a piece of glass, like, so he is very clearly, winning the wearable thing right now. And I guess I just would say, like, Apple rarely gets there first. I think they just get there best. And I think they'll figure it out.
Okay, lastly, Nvidia. I think when I was at your office the last time,
new all-time high yesterday.
Yeah, right. It was approaching $3 trillion, and you're like, if it hits $3 trillion, I got to offload some.
And I didn't.
You didn't. So clearly, you believe that Nvidia has room to go. Does it eventually tail off? Or, I mean, I'll just give like literally 60 seconds on why I think Nvidia might be limited, or like what the case would be that Nvidia is limited. Right? It's that other companies are going to come up with specialized hardware for things like inference. That's going to undercut Nvidia's ability to sell, and also just that their pricing power might not last for as long as they think it will if people aren't going to have real return on this technology. What's your perspective?
I don't know. They just told us they sold out of Blackwell chips for 12 months. Did you?
Okay,
is that what they said?
Okay. Yeah.
So
yeah, I mean, that to me, that's not a surprise.
Listen, this has been the bear case on Nvidia. Is that the hyperscalers will at some point stop spending. And I've made this case before. But like the thing is, nobody knows when. And, there was talk a year ago, NVIDIA is Cisco. And remember all those slide decks and charts and presentations where
that was bullshit.
They overlaid NVIDIA over Cisco circa 1999. It's doubled since then. It's doubled.
Yes.
Can I tell you one last funny thing on this?
Of course. Yeah, definitely.
I just got a dividend from NVIDIA paid into my Fidelity account. Just the idea that they're paying a dividend too is really funny to me.
Oh, yeah. I know.
It's small. Percentage-wise, it's nothing, but it was funny.
Right. Yeah, no, funny. I mean, it's the gift that keeps on giving. Yeah. I mean, it's definitely been... You've been early on it, and to ride it from where you were to where it is now must be just an unbelievable high.
It's the biggest winner I've ever had in my life, and I think you could live another 100 years and not see anything like this ever again.
Right.
So I'm not like beating my chest like, look, I got Nvidia. A lot of people have bought it over the years. I just happen to have gotten into it like really, really early before I was excited about AI. There was no AI.
Yeah.
So I'm happy about it, and I've sold a little bit along the way, but I think my position now is maybe a forever position. I don't know. We'll see.
Wow.
We'll see.
Okay. The book is You Weren't Supposed to See That. Secrets Every Investor Should Know. It's by Josh Brown. You can get it at all bookstores today. You can also listen to his podcast, The Compound and Friends, on your podcast app of choice, and see him on CNBC at the Halftime Report. And every now and again, Josh and I show up there together, and it's always fun to be on with you. Josh, great to see you. Thanks so much for your time.
Thank you, Alex. You're the best.
All right, everybody. Thank you so much for listening. Thanks again to Josh for coming on. Ranjan and I will be back on Friday breaking down the week's news, and we'll see you next time on Big Technology Podcast.